I would start by saying that efficiency has in fact not really been growing too much. So it has been quite stagnant together with productivity. The key thing to recognize is that rig count started to decrease last year in December, but there is a lag effect between when the rig count starts to decrease and when it impacts production. It takes about 8 to 9 months. So it is only now that we will start to see a deceleration in growth. And the reason why production had been growing despite this is that fracking activity or completion had remained pretty much robust. So there has been a large inventory of drilled, not fracked wells that the operators were still putting on production. But with the decrease in rig count, this inventory has decreased. So I think we will now start to see a deceleration in growth.
For tight oil-focused operators, you believe at Rystad that reinvestment rates, the ratio of capex to cash from operations during the second quarter, have hit their highest levels in over 3 years at least. Is this a deviation from the capital discipline approach or just a reflection of inflated operating costs and oilfield services prices?
Yes, so indeed reinvestment rates have been increasing, which is another way to say that expenditures or capex has increased while returns from sales of hydrocarbons have dropped. So I would not say it is a deviation from the so-called capital discipline. It is just a reflection of, as you mentioned, the increase in prices. So expenditures have gone up because activity has gone up, more wells, and the wells are more expensive. And at the same time, oil prices decreased this year versus last. So this ratio naturally had to go up. However, it is still lower than it was prior to COVID. So the industry is cash flow positive, unlike in most of its history. So yes, there is a reversal in this trend, but we are still very much in an era of capital discipline where operators are trying to generate more cash flow than they're spending in shale, which interestingly was not the case even 3 or 4 years ago.
As such, Alexander, how much do you expect growth rates and absolute levels of U.S. tight oil production to be for 2023 and for 2024, respectively? Will the U.S. production exceed the pre-COVID high of 13 million barrels per day anytime soon?
Absolutely, Nasser. I think actually, as we speak, we have probably already surpassed 13 million barrels a day, or we are about to. The latest reported official figures, there's a lag between the reports and now, are from June. 2 months have passed since June, and I think that there is sufficient evidence now to say that we are very close to 13 million barrels a day. If not now, it will be later this quarter, so definitely by the end of this year. Texas already, the largest oil-producing state in the US, has exceeded 5.5 million barrels a day, which is its all-time high, and it's keeping, going upwards. So we will probably exit the year at just above 13 million barrels a day, which would put total US at 12.8 on average in 2023. And for next year, as I mentioned earlier, we expect a slight deceleration. So we will probably hit an average of 13.4 million barrels a day. That's still a growth of over 500,000 barrels in just 1 year, with 95% of this being driven by shale and most importantly the Permian in Texas and New Mexico.
Where do you see currently, Alexander, the WTI break-even price? Where is it at for tight oil wells in the US? And how would those levels contrast between the Permian Basin and other areas? And more importantly, how do these levels compare between today's break-even levels with the levels we've seen in the last few years?
That's a very good question. Break-even prices are a very complex measure. There's a lot of factors that go into the equation. So it's hard to break it down, but it's a very convenient measure to understand what would the price of oil need to be for operators or drilling companies to make a profit at a given oil price. So nowadays, we estimate this to be at around $55, $56 on average in the United States. However, there's areas that are better and areas that are worse. Even at the individual well level, some wells will break even at $30 and some at $80, but the average is around $55, $56. The Permian itself, which is where most of the growth is coming from, is in the low 50s, $49, $50, depending on the area. However, in Bakken or Eagle Ford in North Dakota or South Texas, the legacy shale basins, we're talking more $65. Now, the absolute majority, say 90% or so of the wells in the US will generate a profit for their operators at $70 or $75 plus. Now, as you mentioned, most importantly, how has this changed over time? So if it's 55 now, it was 40 just 2 years ago. 2021 was the year with the lowest break-evens, where you had the highest productivity and lowest costs. Costs have increased over the last couple of years. Productivity has not. So the break-even prices have taken a hit of about $15. However, if you go back, say 5 years, 2018, we were at the same levels as today. And prior to these, break-evens were far higher, as you remember, 10 years ago. So essentially, break-evens went down, 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 hit their minimum in 2021, and now we're back up to where we were 5 years ago. However, we think that we will see a stabilization now. Prices are not increasing anymore, and we have no concerns when it comes to well productivity in the next couple of years.
Let's talk a little bit more about productivity. How are large private E&P shale companies faring in terms of well productivity versus their public peers, according to the latest data available to you?
Yes, that's a good question. So public companies, which today produce most of the oil in the US and actually control just about half of the rigs, or the activity, they tend to have better productivity than their small private counterparts, to the tune of about 15%. So 15% more oil is coming out of those wells in the initial period or even in its ultimate lifetime. The reason for this being that a lot of these companies tend to not have access to the best acreage positions where the majors or large independents have acquired leasing rights for decades. That is not to say that some privately held companies, the very large ones, are absolutely on par with their public counterparts. But on average, we're talking 15% difference between public and privates.
This year so far, we have witnessed only one merger between public independents, but it was a hefty $4.5 billion takeover of Earthstone by Permian Resources. Do you expect the environment to be conducive for more M&A deals in the coming couple of quarters? And in which group of operators, Alexander, would it be concentrated in, you think, the private or the public spheres?
I think the environment is conducive to more merger and acquisition deals over the next few quarters. You mentioned one important one, possibly the only relevant one between independents. However, there have been a lot of deals this year between different kinds of companies. Maybe not the ones we consider the major independents. For example, Baytex from Canada acquired Ranger Oil in the Eagle Ford for $2.5 billion. Ovintiv from Canada as well acquired 3 small companies in the backend for almost $5 billion. Matador entered the Delaware. Civitas acquired Taprock. Chevron acquired PDC. So you have majors acquiring private companies. We have seen large deals. You have public companies or independents acquiring privates, and this is, I think, what we have seen the most this year. So, Vital, Callon Petroleum, Civitas have all made significant acquisitions of private companies. And then we also have the other thing happening, public companies such as Chesapeake selling out their interests in certain basins like the Eagle Ford, sometimes to private companies, although that is a little bit less usual. So normally we see, I think we should be seeing more of the former kind, namely public independents or majors, which are now flush with cash after stellar results in the last few quarters, especially in the last of 2022. They should be most likely looking to acquire smaller private companies and expand their footprint inorganically. I think that's most likely what we will be seeing in the next few quarters. True. And private to private deals.
Absolutely. Alexander, let's move on to shale gas players. These players have experienced negative free cash flows in the second quarter. Rig count has also been on the decline for them. How do you see activity in this sector moving forward in the medium term and on the more longer term, especially in light of expectations of increased demand from U.S. liquefaction plants to satisfy winter LNG demand in Europe and in Asia?
That is a very exciting question and point. So you're right, there is a disconnect between what oil companies, which we've been talking about, have been doing and what they're planning, so still kind of moderate growth. However, on the gas side, it's very different. Negative free cash flows, gas prices have collapsed since the earlier this year. And to understand the future, it's important to understand why the gas prices have collapsed. There is no takeaway capacity, midstream bottlenecks all over the place, no demand, and especially no access to international markets, at least not sufficient of it. So as you mentioned, LNG plants, liquefied natural gas in the coming years, will open the doors to an international market for the gas producers, and that will be naturally very positive for them because there will be an outlet, so they will be able to increase their activity. However, in the short term, gas prices will possibly remain depressed throughout this year. However, there are expectations. I think the industry recognizes that gas prices will increase early next year prior to LNG facilities coming online because of seasonal demand. For example, the forward curve for Henry Hub, which is the gas benchmark, is at least 30% above what it is today. So strong backwardation. Most of these gas players, even though they're cash flow negative, they have not entered into hedges to protect from low gas prices next year. In other words, they are confident that gas prices will increase next year. So there is hope, so to speak, in the horizon for them to return to a cash flow positive situation.